Welcome to the Explainer! Today, we're diving straight into something absolutely crucial, but let's be honest, kinda intimidating: the basic anatomy of a company's financial statements. We're gonna take those massive, complex spreadsheets and break them down into clear, easy-to-understand pieces. So think about it. How do you really know if a business is absolutely crushing it, or if it's literally just a few weeks away from going under? Whether you're a lender deciding on a loan, an investor hunting for that next big opportunity, or even a small business owner just trying to keep the lights on, gut feelings simply aren't going to cut it. You need hard, concrete evidence. Well, you can think of financial statements as a business's ultimate report card. They're these formalized, written records that meticulously track the business activities and financial performance of a company. In the corporate world, these records are the universal language of business. They're audited to ensure absolute accuracy for tax purposes, financing, or investing. Okay, let's dive into this. To get a complete picture of that financial report card, we rely on three core documents. We call them the Big Three. They are the income statement, the balance sheet, and the cash flow statement. Each one tells a totally different part of the company's story, and honestly, you really can't understand the full narrative without reading all three chapters. Let's start with the income statement, which you might sometimes hear called the profit and loss statement. Think of this one like a video recording over a specific period of time, say a quarter or maybe a full year. Its entire job is to illustrate profitability. It answers the one simple question: is this business actually making any money? It does this by starting with all the money coming in and then carefully deducting every single expense it took to keep the operation running. To put that into perspective, let's look at a really simple example. Imagine a small business selling handmade furniture. Up at the top, you've got your revenue. That's the cash from all the tables and chairs you sold. But you don't get to keep all of that. Next, you have to subtract your expenses. That's the cost of the wood, the wages for your carpenters, the rent for the shop, and of course, taxes. After you deduct all of that from your revenue, you finally arrive at your net income. This is famously known as the bottom line. If it's a positive number, great news, you're turning a profit. All right, moving on to the next statement. Let's see how this builds. We have the balance sheet. Now, if the income statement was our video over a full year, the balance sheet is a photograph. It is a snapshot frozen at one exact specific point in time, usually the very last day of the fiscal year. It shows exactly what a company owns, what it owes to others, and what belongs to the owners on that specific day. The absolute best way to visualize the balance sheet is like a giant scale. On one side, you've got your assets. This is everything the company owns that actually has value: the cash sitting in the bank, the inventory piled up in the warehouse, the equipment they use. On the other side, you've got liabilities and equity. This side answers the question: how exactly did you pay for those assets? Did you take out a bank loan? Well, that's a liability. Did the founder invest their own life savings? That's equity. So here is the crucial point. The fundamental accounting equation is that assets must always equal liabilities plus equity. Everything the company owns was financed either by borrowing money or by money from the owners. If a company has $100,000 in equipment, it either owes $100,000 to a bank or the owners have $100,000 of equity tied up in it. This is exactly why it's called a balance sheet. It literally has to perfectly balance out. Now for the third of the big three, the cash flow statement. You might be wondering, if we're already tracking profits, why on earth do we need this? Well, here's a rather surprising fact. A company can be highly profitable on paper, yet still go bankrupt because they simply ran out of actual money to pay the bills. This statement strips away all those complex accounting rules to strictly track the concrete, physical cash moving in and out of the bank. To make sense of all this cash movement, the statement breaks it down into three simple buckets. First up, operating activities. This is the day-to-day cash from paying suppliers and collecting from customers. Second, investing activities. This is cash spent on buying big, long-term assets, like a new factory, or maybe cash gained from selling one off. And third, financing activities. The cash you get from taking out a loan or issuing shares, minus the cash you use to pay that debt back. Linking it all together, the golden thread of net income. Now, what's really interesting here is how these standalone documents actually link together. They aren't just isolated spreadsheets, they're an interconnected ecosystem. Here is exactly how that golden thread of net income weaves right through them. Step 1, you calculate your net income over on the income statement. Step 2, that exact number jumps over to become the starting line on the cash flow statement. Step 3, that same net income flows directly into the balance sheet under equity, into a category called retained earnings,
which is basically just the cumulative profits the company has kept over time.
This is exactly why lenders and investors demand to see all three of these statements, usually spanning back 3 to 5 years. Think about it. An income statement alone might show a company is super profitable, but the balance sheet might reveal they're completely drowning in debt. Or maybe the balance sheet looks totally fine, but the cash flow statement shows they are burning through their cash reserves dangerously fast. Only by linking all three together do you get a transparent, three-dimensional picture of risk and operational efficiency. So, the next time you're handed a set of financials, just remember, you're really just looking at a video of profits, a snapshot of balances, and a tracker of cash, all perfectly tied together by the bottom line. But here is the real question I want to leave you with today. The next time you see a flashy headline about a massively profitable company, will you take it at face value? Or will you wonder if they actually have the cash to survive tomorrow? Thanks for exploring this topic with me, and I'll catch you on the next explainer.